Hello and welcome back to the Canadian Money Roadmap Podcast. I'm your host, Evan Neufeld. Today we're looking at kind of a big picture concept for shaping how you view your investing and other parts of your life, I guess, too, when we're talking about expected returns. When it comes to almost anything in life, expectation management is so important. How much you enjoy your vacation, how much you're going to enjoy a movie, what you think of your job, how painful a medical procedure is going to be. All these different things revolve around our idea of expectations, what we think is going to happen versus reality. In your investing life, expectation management is also really important because it helps take some of the emotions out of investing. It helps you ignore the noise on the extreme ends of the fear and greed spectrum. Because if you know what to expect or have a reasonable guide to point you to what you should expect, you're way less likely to be drawn in by something that might be a scam or too good to be true, or to get too down when things don't work out as expected. Expectations will also help build your projections of the future and guide how much you need to be saving. So are you saving based on the assumption that you'll get 12% returns per year for the rest of your life, or maybe 3%? How do you know what's reasonable? So without an expectation that's rooted in something reliable, you're guessing, you're hoping, you're wishing, you're gambling, and you're probably ignoring reality to some extent. So today I'm going to talk a little bit about expectations and how you can think about that for your own life and for your investments. So let's start by looking at some examples of how you can use expectations in other parts of your life. I'm going to talk about a few nerdy things maybe, but one of the best sports for using data to guide expectations, it's got to be baseball. There's so many crazy stats in baseball because it's such a high volume game where a batter might have 4 or 5 times up at the plate every game, and they play 162 games a year. It's unbelievable the volume of data that you can get from baseball. So one of the things that I've enjoyed poking around at is looking at expected runs in baseball to you can gauge a scenario to see what's likely to happen. Because just as a pure fan, which is the fun part, to be completely honest, the fun part about baseball is just watching and not knowing what could happen next, right? So say that the Blue Jays are down 2 runs and they've got runners on first and third with 2 outs. What are the chances that they can actually pull this off, right? This happened recently, and so I'm watching it, and we've got a few hits in a row, and I was like, okay, we're rolling now. You know, Vladdy's coming up to the plate. He's a good hitter. I feel like he's going to hit a home run here. Chapman isn't good against lefties, so there's no way to have, all these different things you start feeling. But you can actually calculate these things, right? So there is a few different stats that you can look at that calculates all these different scenarios based on how many outs there are and all the different positions on base. So if you're not a baseball fan, there's first, second, third base, and you're out after the third out. And so there could be any number of scenarios between having 0 outs, 1 out, and 2 outs, and runners nowhere, or on any combination of the 3 bases. So there's 24 different potential outcomes there. So within that, the crazy people behind Sabermetrics, they put together all this data to figure out what the odds are in any given scenario. And then you can benchmark that against what actually happens to a player and things like that. But for an example here, let's say there's no outs and you've got a runner on third base. It's pretty close to coming home. You could have a sac fly, all these different scenarios. The expected runs for the rest of the inning, in this case, is 1.35. So if you're in a scenario where this happens, it's more likely than not that you're actually going to score a run here. Are there scenarios where you don't score a run? Absolutely. Absolutely. But we use expectations to guide decision-making. And in the case of baseball, you can have a little bit of fun with those when you're watching a game. So in this case here, again, no outs, runners on third base, and you're batting. The most probable outcome is actually 1 run, even though the expected runs are a little bit higher than that. Okay, because expectations aren't guarantees. Expectations are based on a large data set of what you could expect on an average over a long enough period of time. So let's give an extreme end of the other side where expectations didn't necessarily matter. So a couple weeks ago, Blue Jays were playing against the Tampa Bay Rays, and they're in the ninth inning, and there's 2 outs, no one on base, and I think it was the first baseman was pitching. Like, this game was a blowout. It was a bit of a joke. But the Blue Jays are hitting, again, 2 outs, no one's on base. The expected runs in this scenario were 0.09. Okay? So you should expect that this game is done. And they end it right there. However, what happened after that is they scored 9 runs. Okay? And in the data set that I'm looking at here, this has happened 9 times before. It goes back to 1957. And so the probability of that happening was 0.00047. The probability was really low, but it still happened, right? So just because you can have expected returns or expected outcomes, that doesn't mean that it can't happen, but you shouldn't be watching a game or planning for that if you're the coach. It's just not realistic. So let's put that unrealistic expectations into another context. Let's say you're playing the lottery. So I don't know if the Lotto 649 is something across Canada, but we've got that here in Western Canada. Essentially, the way that works is that you pick 6 numbers between 1 and 49, and if you get all 6 right, you get your share of the grand prize, which I think is $5 million. And so the way that you calculate the odds, essentially, you've got pretty close to 1 in 14 million odds of winning that prize. So it's not astronomical, but it's pretty high. You don't have a really good chance of winning here. But the way that we can kind of figure out your expected returns here is if you multiply your odds of winning by the prize value, you get your expected return. So in this specific lottery case, you should expect to win 36 cents per ticket, which costs $3, right? So you should expect to lose $2.64 every time you play the lottery. So again, what I'm saying here is that even though there is a winner and you can win, and I know people that have won actually, the expected returns are still 0. So should you play the lottery expecting to win? No. Is it possible to win? Yes. You just shouldn't expect it. Okay. So if I'm planning my financial life, I'm not looping in lottery tickets as a way to increase my odds of success because it has expected returns of 0. Same thing goes for things like cryptocurrency, even like regular currency, like US dollars or whatever, precious metals like gold or silver, collectibles, baseball cards, NFTs, whatever you want to collect. The expected returns of something when we start talking about the stock market or an investment or properties or anything like that are based on expected cash flows generated by an asset or something that has an intrinsic value like a property. Things like gold and silver, they don't spit off any cash flow. Cryptocurrency, don't get me started on that. I'm not a believer in the investability of crypto because you can't value it from my perspective. There's some ways, I guess, that you could throw a value on it, but those things that are purely speculative or their values driven by just supply and demand in that moment or perceived scarcity, to me, that's not a reliable way to invest. Because it carries additional risk. Like the value there is subjective. It can be influenced by speculation by others, market preferences. These kind of things I don't believe are reliable. And so I don't assign expected returns to things like cryptocurrencies, precious metals, collectibles, anything like that. So when we talk about the stock market, how can we actually take a look at these things? Because there should be expected returns for these assets, bonds as well, but I'm just going to talk about stocks today. How can you actually look at these things and put a value towards them? Well, there's a couple of different ways that you can look at it. One would be historical analysis. I don't agree with this one necessarily because it just says, okay, well, what did it do in the past and what's it going to do in the future? This is like the classic disclaimer, like past performance, it does not guarantee future results. I would say, sure, maybe it's a bit of a guide, but it's not super reliable. Next one would be fundamental analysis. So it looks at a company's financial statements, how much money they're making, what assets they have. You can assess factors like revenue growth, profitability, debt levels, industry dynamics, and then you can kind of extrapolate those over the future as well. So I would be more of a fundamental analysis proponent, but I'll come back to that in a second. Another way you could look at it is technical analysis. Again, I think this is a complete waste of time. This is like astrology for finance nerds. You take a look at different charts and they start throwing lines up there. It's like, oh, this is a head and shoulders pattern, or oh, we're working on a double bottom here. Like all these different like patterns and whatever that they see in price charts and based on trading volume and trend lines, moving averages. It's not all hocus pocus, but most of the scammy things that I see on the internet related to money have to do with technical analysis, because it seems like magic and it's complicated and it seems like someone could have an edge in this way. I don't believe it's true. I don't think it's complete zero, but I wouldn't waste any time valuing the market on technical analysis. Another thing you could do is economic analysis. Over the last year or so, this has kind of been where people have come out of the woodwork and suddenly become economic experts because the things that are driving the market were things that were largely big picture, like inflation and interest rates. That has not been the case for the better part of the last 40 years. And so the people that have really focused on like macro analysis, Ray Dalio would be one, if you've ever heard of him. He runs a massive hedge fund. They're few and far between. This stuff is very complicated, and there's a lot of trickle-down effects when you start looking at the different economic indicators and factors around the world and how they impact global markets and so on and so forth. Even the experts that are pulling the strings on these things at central banks and whatnot, they've got all the information that you could possibly want in this regard, and oftentimes they're playing catch up. So investing based on the macroeconomic outlook seems intuitive, but it's also virtually impossible. So I don't put a ton of weight there necessarily. Another one would be seeing what other people think. So call it analyst estimates, or worse, what does your brother-in-law say about it? But like even experts here, they'll take a look at, they'll meet with management of the companies and they'll take a look at the products, what they've got in the pipeline. But you can look at qualitative and quantitative things within it, company-specific factors, industry trends, market conditions, a little bit more under the hood type of analysis. And a lot of times that can be a really good way to do it. It's just really difficult for individual investors to do that. If you're looking for that kind of thing, active mutual funds or hedge funds have been the traditional way to get access to this amount of volume of information, because these funds and fund companies have armies of analysts that are doing this all around the world. Do not try to compete with them. If you think that there is value to be had here, just use them. If you don't believe in the value that they add, just don't go that route at all, and don't think that you can outsmart these people that are spending billions and billions of dollars trying to get an edge in the market. So when you see a headline on CNBC or Bloomberg or Reddit, and then you start buying and selling stocks based on that, it's like, sorry, you are late to the party. Okay, so the thing that I take a look at most for a high value expected return calculation usually looks at valuations. So that's kind of the fundamental analysis of like a market or a stock. And so the idea there is, if you're looking at valuation and saying, what are you paying today for the assets and cash flows of the company? So if you're owning them for into the future, it's always going to be higher than what the value is today, assuming that company grows over time. So when we look at the valuation of a company, one of the easiest ones, or the most commonly quoted ones that people look at, is something called the PE ratio, or the price to earnings ratio. What this looks at is, what is the price of a stock versus how much money does it make? Earnings is a kind of corporate jargon for profits. And so I've just pulled up the S&P 500 PE chart here, and you can take a look at different parts of the market and you can see, what are you paying today for earnings in the future? Let's use a few examples here. Apple, biggest company in the world. Currently, they have a price to earnings ratio of 29.8. Let's call it 30. Essentially, what that means is that you're paying, when you buy a share of Apple, you're paying 30 times the profit that it currently makes to own it. So if you're thinking of it in payback terms, you'll kind of make your money back over 30 years, assuming the company doesn't grow at all. Apple is probably one of the most growth-oriented companies in the history of the planet. So we would probably expect some growth over time, but that's not a bargain necessarily. All depends on the growth rate of the company and things like that. But that's one metric that you can look at there. Let's compare that to something that's really a completely different field. Let's look at ExxonMobil's. So right now, Exxon has a price to earnings ratio of 7.1. There's a number of reasons for this, and low doesn't mean good, high doesn't mean bad, but I'm just kind of showing you some examples of where these could fall. So on that same note, Exxon would take about 7 years for you to get your money back at the same level of earnings, assuming they actually share those earnings with you as shareholders. So I am of the belief, largely speaking, that there is money to be made in looking for low-priced stocks. We call those value stocks. I've talked about that on the podcast before. If you want to go look at that episode about value investing, you can do that. I'll probably do some more about that in the future. But historically speaking, buying stocks that are in the lower third of valuations have typically driven higher returns over time. So how do we use this PE ratio to get a bit of a guess on future returns? Again, this isn't exhaustive. This is not super scientific. It's just kind of a little bit of a quick guess or a quick rule of thumb. Way that you can look at this is by using the PE ratio. And so if you take 1 divided by the PE ratio, or the inverse, sometimes we call it earnings to price then. Sometimes we call that the earnings yield. So let's use ExxonMobil, for example, here. So I'm taking 1 divided by 7.11 today. That gives me 14%. So rough and dirty rule of thumb, if you're investing in ExxonMobil, perhaps that could be a rate of return that you could use as a rough expectation in the future. Alternatively, let's look at Apple. So I got 1 divided by 30. It's closer to 3.3%. It's like, why is that the case? Well, let's just look at it logically here, perhaps. If Apple is the biggest company in the world, is it possible that they can continue to grow earnings as fast as they did in the past? Or is it possible that once you get so big and everybody has an iPhone and so on and so forth, maybe your growth rate starts to slow down a little bit? And so the reasonable expectations from where Apple is today, it's highly, highly unlikely that they'll be as high as they were in the past during their massive growth phase. So this kind of makes intuitive sense, right? Price is what you pay, but value is what you get, right? So if you're overpaying for profits today, it's going to be really tough to make returns in the future. Let's use a crazy example of Nvidia. If you've never heard of Nvidia before, you probably should, and you're going to hear about them a lot very soon because they make all the computer chips that most of the AI platforms are using behind the scenes to actually run all of the artificial intelligence software. There are a few other companies, but Nvidia is the biggest and baddest, and they recently released their earnings with their expectations of future revenues, and the stock price took off like crazy. So Nvidia is a very volatile stock. It was down, I think, about 70% last year, but then this year it's already up 166%. It's like, oh my goodness, this is crazy. And so if you're looking at Nvidia saying, my goodness, it's up 166%. I got to buy some of this because it's going to keep going. Think about it. What are the odds that this thing keeps going up at the same rate? I would say very low, very low. The way that the stock is priced right now, it is already pricing in massive growth in the future, massive growth. Because if we look at a few different valuation metrics, I'm just going to stick with price to earnings because that's the one that I was using before. ExxonMobil's got a 7 PE. Apple's got a 30. Nvidia is currently at a 202 price to earnings ratio. Okay, it's going to take you 200 years to get your money back based on current earnings. So this company's got to grow like mad for you to ever be able to make money today, right? If you bought this stock 6 months ago, you're laughing, right? But if you're buying it today, your expectation of returns cannot be the same thing. It's possible. Let's use that lottery example again. It's possible, but you're buying a lottery ticket. When you overpay for a stock today, you are buying a lottery ticket hoping that you're the one that wins the $5 million when your expected returns are 0. Let's do the same exercise here with Nvidia. 1 divided by 202. Your expected returns on this stock from today, again, just based on my rough and dirty earnings yield math, 0.5%. Okay, so I say this as a cautionary tale based on this concept of expectation management. If you're looking at an individual stock that has recently gone up, Your expectation for returns in the future should not be based on historical returns, meaning what did it do yesterday? Try to reassure yourself that you are late to the party, and that's okay. Because if you're owning a broadly diversified portfolio, you probably own a little bit of Nvidia anyways, but that's another conversation. But if you're buying it after a stock has already gone up so much and it's expensive based on how much profit it's making, you cannot expect that the future returns will look anything like the ones in the past. Okay, so what are some actual numbers that we can use here going forward? FP Canada, so Financial Planning Canada, they provide a bit of a guide based on a number of things. They use all sorts of different projections based on the economy, valuations, and all those kind of things, which I've already talked about, which is great. And so us as financial planners, we use the guidelines, which are much more complicated than just doing a inverse of a PE ratio. But they use these to kind of guide how we build portfolios for clients and how we use them as guidelines for future projections. So the way that I typically build portfolios for clients, I like having globally diversified portfolios. So some Canada, some US, some international, some emerging markets. Each of these have different expected rates of return. If you go back to my episode about building your first 100,000 in the stock market, I have a little spreadsheet there that you can download that includes these guidelines for 2023 for each of those different categories. But broadly speaking, if you're invested in a globally diversified stock portfolio, maybe using an asset allocation ETF or something similar, the expectation for returns would probably be in that ballpark of about 6.3%. Depending on whether you're doing it yourself or how you're building your portfolio, it could be reasonable to go 1% in either direction there as far as an estimate goes. But that's the number that I think would be completely reasonable for you to use as far as your long-term projections go. There are going to be years where it's much better than that. There's going to be years where it's much worse than that, but you could have a reasonable expectation of that on average over your investing life. And I think you'd be in pretty good shape by using that as kind of your guidepost. Now, if something underperforms, so if you have a year where you're down 10%, no, that is a possible outcome at any given point. However, the next year, your expectation should probably be the same, if not actually a little bit higher. Vanguard is a company that I've talked about before. Their US capital markets division actually puts together some modeling for future expected returns. They use three main elements to come up with their projected returns. They say, number one, a global dynamic model that forecasts the drivers of long-term asset returns, such as yield curves and equity market valuations. Number two, attribution models that attribute asset returns to the drivers. And three, simulation engine to model the probability distribution of outcomes. Okay, what does that actually mean? They say, okay, what actually drives returns of the market? One of those largely being valuation, like I already discussed. And then they use simulations to say, okay, how often does this actually happen? Looking at the past, looking at volatility, what are things that you can reasonably use? And they use something called a Monte Carlo analysis for that, which is pretty cool. And I can use that with my clients as well on our financial plans. So I'm a big believer in using expectations to guide both the average, which is kind of what we've been talking about so far, but also the potential downside or the volatility along with that. So Vanguard caught some heat for their return projections as of the end of 2021. And they were saying that U.S. equities should, over the next 10 years, should provide returns in the realm of 2% to 4%. And people are just losing their mind. It's like, what? This is crazy. And their justification for that was based on the valuations. So at the end of 2021, stocks had kind of been going crazy at the end of 2020, so coming out of COVID and continuing on. And that's right when this whole inflation thing started to hit, but before interest rates started going up. So when interest rates are really, really low, markets are going to keep going regardless of valuation. So the valuations of the stock market started to get really, really crazy. It made sense, but it guided the expectations of the future. So if you were putting money in on December 31st of 2021, you could not expect that that dollar would continue to earn the same types of returns that you had seen in the markets in the previous two, which is why people were kind of losing their minds. Now those same returns today for U.S. equities, from Vanguard, they project that to be between 4.1 and 6.1. Again, pretty close to what I was saying before. And that is based on what? The fact that valuations have improved. So stocks aren't nearly as expensive as they were 2 years ago. And so you can reasonably expect that going forward, the returns on those stocks should actually be better. Okay, so that's how you can kind of use valuation as a bit of a guide for your expectations. PE ratio is one. If you really want to get nerdy and look into something called the CAPE ratio, that's called the cyclically adjusted price to earnings ratio, or the Shiller PE. There's some really cool research around that kind of thing. It just kind of puts the PE ratio on steroids a little bit. But I think that understanding valuation is really, really important. So you don't get caught up in these ideas of chasing returns or recency bias. Just thinking things that will continue on the same pace forever. Last little example of this outside of the investing world. Recently, there was a major golf tournament, and one of the invitees was a golf pro, essentially from a local course. This isn't Dustin Johnson or Tiger Woods or Rory McIlroy here. This guy's name is Michael Block, and he's in his 40s, and he teaches lessons, and he kind of runs a golf course, and, just pretty average guy, but golf is his job, but he doesn't get to play that much because he's actually got to run a course and give lessons and all that kind of stuff. Anyways, he got invited to this tournament. They do that from time to time, and he did exceptionally well. Like, he made it to the final round of this major tournament, and I think he finished in the top 10 or the top 15 or something like that, which is unbelievable against the best golfers in the world. And, everybody, the story's going all over the place. It's like, wow, this guy is great. Imagine if he had another chance. And so the next tournament that was coming up, it's like, hey, we'll send an invite out to this guy and kind of keep this story going. And he's given interviews, and someone's like, hey, so, you got to play with Rory McIlroy. Like, what's the difference between your game and his? And he said, oh, well, if I could hit it as far as Rory McIlroy, I'd be right up there with the best in the world. The guy's like, really? Oh yeah, for sure. My putting and my chipping is absolutely elite. All this kind of stuff. He was reading his own book there. Fast forward to this past weekend, where he got invited to the next tournament in the calendar. It's called the Charles Schwab Challenge, and a lot of the golfers you know and love would be in this tournament. And Michael Block, all eyes are on him. This guy that's kind of coming out of nowhere. Can he do it again? Nope, got dead last. Literally dead last. And he didn't make the cut, which means he only made it through the first 2 rounds, and he got last. Does that mean he's actually the worst golfer there? No. Was he actually the 15th best golfer in the world based on last tournament? No. The expectations for this guy, he's like, he's probably a pretty good golfer. Could he reliably compete consistently with the best in the world? I'm going to say probably not. Right, so when you invest, maybe you're picking individual stocks. I don't recommend it, but if you're doing that, maybe take a valuation approach. Maybe buy stuff that has a reasonable expectation of future returns, as opposed to buying stuff that had already gone up. To reference another episode that I just did reviewing Ramit Sethi's Netflix series called How to Get Rich, one of the people featured on the show did this exact thing, where during the pandemic, he thought he'd get smart and try to pick stocks, and he bought DraftKings, and he proceeded to lose almost $80,000 on this because, guess what? He bought it after it had already gone up, and it already had baked in all of the growth. And turns out the future expected returns on that, when a stock is very, very expensive. I don't even know if DraftKings is profitable, to be completely honest. That's another wrinkle. If a company doesn't even make profit, their PE ratio is going to be infinite. So if you see a company that has no data for a PE ratio, I would say double check your expectations on that. You could see some growth over time just purely on speculation. I would say it's largely unfounded based on anything that's reliable. So if you're going to throw some money at it, assume that it's going to be a bit of a gamble, but know that your expected returns on that are going to be pretty low. Anyways, hopefully this was kind of an interesting conversation here just about expectations, some things that you could expect, some things to avoid. The biggest thing I hope you take away from this is that when you see headlines of a stock that's really taking off, it's Nvidia today, it was GameStop yesterday, whatever it is, use a framework of expectations or expected returns in the future to guide your decision making. Do you really think it's going to keep going up forever? Maybe. What other things can we use to make sure that when we're investing in the markets, we're making good decisions? hopefully some conversations around expectation management here help with that. And hopefully you can make better decisions with your investments going forward. Thanks so much for listening. We'll catch you on the next episode. Thanks for listening to this episode of the Canadian Money Roadmap Podcast. Any rates of return or investments discussed are historical or hypothetical and are intended to be used for educational purposes only. You should always consult with your financial, legal, and tax advisors before making changes to your financial plan. Evan Neufeld is a certified financial planner and registered investment fund advisor. Mutual funds and ETFs are provided by Sterling Mutuals, Inc.